Imagine this. You and your friends build a huge tower out of blocks. Everyone keeps adding more and more blocks, higher and higher. It looks amazing. But there's a problem. Some of the blocks at the bottom are weak, and nobody checks them. Then, one day, the tower collapses. That's basically what happened in 2008. And when it fell, it didn't just affect a few people. It affected the whole world. Even giant banks like Lehman Brothers disappeared. The easy money problem. Let's make it simple. A long time ago, the Federal Reserve made borrowing money very cheap. That means banks could give out loans easily, and people could borrow money easily. So everyone started buying houses because they were told owning a house is better than renting. At first, this was fine, but then it got out of control. Giving money to everyone. Banks wanted to make more money, so they started giving home loans to almost anyone, even people who didn't have stable jobs, even people who didn't have savings. Sometimes they didn't even check if the person could pay the loan back. There was even something called a ninja loan. No income, no job, no assets. Still approved. It was like giving a very expensive toy to someone and hoping they'll figure out how to pay later. The big mistake. Now, here's where things get tricky. Banks didn't keep these risky loans. They packed thousands of them together and sold them to investors as something called mortgage-backed securities. Think of it like this. Imagine mixing good apples with rotten apples and selling the whole basket as fresh. Investors around the world bought these baskets. Why? Because they were told they were safe. Making it even worse. Then Wall Street made things even more complicated. They took those baskets and mixed them again into new products called CDOs. Now nobody really understood what was inside anymore, but everyone kept buying them because they made money. At the same time, some people started to notice something was wrong. They saw that many homeowners wouldn't be able to repay their loans, so they made a bet. They bet that the system would fail. They used something called credit default swaps, which is basically insurance that pays you if things go bad. The collapse begins. Then the problem finally showed up. People started missing their house payments. More and more houses went into foreclosure. And then something shocking happened. House prices started going down. That was a huge problem because the entire system depended on prices always going up. Once prices fell, everything started breaking. The crash. In 2008, the system couldn't hold anymore. Big banks started failing, and then one of the biggest shocks happened. Lehman Brothers went bankrupt. That scared everyone. Banks stopped trusting each other. They stopped lending money. Businesses couldn't get loans. People lost jobs. The whole economy slowed down. The rescue. The government had to step in. They created a program called the Troubled Asset Relief Program and used about $700 billion to save banks. At the same time, the Federal Reserve lowered interest rates again and pumped money into the system. This helped stop things from getting even worse. The real impact. Even though the system was saved, people suffered. Millions lost their jobs. Millions lost their homes. Savings disappeared. And many people felt something wasn't fair. Big banks got rescued, but ordinary people had to deal with the damage. The lesson. So what can we learn from this? The 2008 crisis happened because people believed something too strongly, that housing prices would always go up. But when that belief broke, everything fell apart. Just like that block tower. Because sometimes the biggest problems start small and grow quietly until suddenly everything crashes.